Hi, this is Kelvin here again. Welcome to Module 10, Risk Management Part 2, a series of education webinar, which is Trade the Markets Like a Pro. So now let's take a look at the disclaimer slides first before we start. All right. So if we could recall last module 9, which I shared with you all, if we do not maintain a prudent way of trading, that means we allow to have a higher capital loss. In order to make back 50% loss, we need to have a 100% return on our trade. 70% loss, we need to have another higher exponential return in our trade, which is 233%. That means the percentage of loss gets larger. It tends to have a very negative impact on our trading. That means, i.e., we need to make much more to cover back our losses. Hence, the essential of risk management is very important, is to actually maintain our capital loss in every trade at a manageable level in order for us to stay long in the market, that survivorship, to actually have positive expectancy. That means in order to become a more profitable trader. Why? Because at the end of the day, staying long in the market, managing our losses to a manageable level or a sensible level allow us to have more bullets to find further trading opportunities. All right. So in order to do that, let me share with you this percentage risk model. So it's part of this position sizing, which is the key to preserve your capital. So what is this percentage risk model about? Okay, so let's say for example, we have a trading capital at a start of 10,000. I already preset a maximum loss per trade is to be at 2% of my trading capital. Then based on this 2% of trading capital, I will be able to know what is the number of units maximum that I can long or short, okay, depending on the trading strategy, based on the risk per unit. All right, so what is this risk per unit and how do we calculate that go on using that 2% trading capital? So let's look at this example, which in my previous module I shared with you this multi-time frame trading strategy. This is a bullish one, the bullish leg. So let's say this example, I already calculate the reward risk ratio of this bullish multi-time frame trading setup. It has the expected risk of 61 points. All right, so I'm assuming now 1 point is equals to $1 on the SPX 500. All right, that means my risk over here is 61 points, which is equal to $61. All right, if I were to go long one SPX 500 unit. So based on this 61 points of expected risk, I'm able to calculate the number of units to go long. Okay, so I do it step by step. Trading capital at the start 10,000. Maximum loss that I could afford, I'll set it at 2%. So this is the fixed percent risk model. 2% of 10K give me 200. So that's my maximum loss that I already set. The expected risk per unit, assuming that one unit equals to $1 on the SPX, $61. So number of units to go long will be the maximum loss that I could afford to lose divide by 61. So this give me 3.27, round down 3. So i.e., if I were to actually long 4, so I'll be going against my trading system. Okay, so a trading system actually consists of position sizing. So if I have to long 4, my maximum loss will not be 200 already. I'll be more than 200 means I'm trading above 2%. All right. So at the end of the day, if I were to go long by more than 3 units, I will be facing the risk of ruin. All right. So to keep it the simple short, the amount of units I could lock is maximum 3 units based on this 2% of trading capital. Okay. So now you know that over here is that the importance of position. How do we calculate position sizing? And in order to have we call it a high probability winning edge in my trading system, I need to obtain positive expectancy. So what's positive expectancy is broke down into two components called the accuracy edge and the monetary edge. So the accuracy edge is actually defined by greater than 50% profitable outcome. So it's actually a calculation of your trading system or your trading strategy win loss rate or the win loss ratio. I would say your monetary edge is your trading system or trading strategy. In every trade setup you use, the reward risk ratio, or I call it the reward risk relationship, where the expected reward is more than the expected risk in a trade. Okay, for example, let's have a track record. So if we need to maintain, we need to have a track record of at least 50 close trade to have a meaningful sample size. So based on this 50 close trade at a minimum, we could calculate your average winning trade and the average losing trade in dollar terms. Then I will be able to calculate the percentage of winning trades and the percentage of losing trades. All right. So winning trade is very simple. It's defined by the trade that hit your profit target. Losing trade is your trade that hit your stop loss. All right. Expectancy is basically the formula of average win in dollar terms multiplied by the average trade in percent terms. So that's actually your win rate minus off your average loss in dollar term multiplied by your losing trades. So that's your loss loss rate. Okay, so let's take a look at this strategy A over here. So your strategy over here, your winning trade is 40%, your losing trade is 60%. So what I could see is that the win-loss ratio is 0.67, less than 1. Why? Because your losing trade in terms of percentage is more than your winning trades. Then, but however, if I plug the figure in the formula, I'm still able to get 200, which is good. It's a positive expectancy. Now, let's take a look at strategy B over here. Over at strategy B over here, the winning trades and losing trades is the same as strategy A. All right. The win-loss ratio is at 0.67%. But however, at the end of the day, my expectancy now is negative. So what is the main reason? So the main reason actually lies on here. All right. Your reward risk ratio. So in strategy B, your reward risk ratio is actually 1. Okay, because average win divided by average loss, 1,000 is 1. In strategy A over here, you realize that your reward risk ratio is actually 2, 2,000 divided by 1. So what we could see over here is strategy A able to get a positive expectancy. Why? Because I'm having a reward risk ratio that is more than 1. That means my winning trade is able to actually have obtained a higher reward versus by the higher risk. So that actually offset the win-loss ratio of less than 1. So it's able to give me a positive expectancy. Okay, so now let's take a look at strategy C. So strategy C over here, the win-loss ratio or the reward risk ratio now is 1. Okay, my winning trades and losing trade now has increased. Okay, I have 60% winning trades, losing trade is 40%. So this give me a win-loss ratio of 1.5, more than 1, because now my this trading system or trading strategy is able to generate more winning trades. All right. So over here, you realize that my positive is a positive expectancy if I plug the figure in. Now, strategy D. So let's look at strategy D over here. The reward risk ratio is still the same, or is higher now. Pardon me, is higher compared to strategy C is 2. What remains the same is your winning trades and losing trades. Over here, the win-loss ratio is the same, 1.5. All right. So what's different only here is the reward risk ratio has jumped up by 2, whereas your win-loss ratio still maintain the same at 1.5. So the effect of why is it higher positive expectancy is because of my reward risk ratio has improved too. So what you could see over here is that if I were to have the best scenario, win-loss ratio of more than 1, that means more winning trades and losing trade, and a reward risk ratio of 2 or more, my positive expectancy were able to jump much higher to the positive side. All right. So this is the ideal scenario, ideal trading strategy or the trading system that I want. So roughly based on the 4 trading example A, B, C, D, E, I believe that you guys have able to have a rough idea. There's actually a trade-off between reward risk ratio, and win loss ratio. So let me present to you in this table over here. All right. So this column here is your reward risk ratio. This is this column here is the required win rate to break even. That means, i.e., to have a positive expectancy of zero. Only break even. That means, in order for you to have meaningful profit, you need to be higher than the whatever expected rate. Okay, so now what I'm going to share you is we do step by step. Let's say, for example, we have a reward risk ratio of 0.5. Your required win rate will be higher, 67%. Your reward risk ratio of 1, your required win rate to break even is 50%. If you go all the way down, let's say it's 2.5, now you have a higher reward risk ratio, but my required win rate actually reduces to 29%. If you have 3.5, higher reward risk ratio, my required win rate actually dropped to 22% in order to break even. So what we could see over here is the higher the reward risk ratio, the required break even win rate will decrease exponentially. That means if my trading system has or trading strategy has a higher reward risk ratio trading setup, in order for me to have that means my required win rate actually drop. All right. So as you all know that trading there is no 100% win rate. Okay, there's no system that give you 100%. So if my reward risk ratio is higher, I could actually offset the randomness in my trading system. That means in order for me to require a lower win rate to break even. All right. So my formula to calculate the required win rate to break even is actually 1 divided by 1 plus the reward risk ratio. All right. So as you could see over here is that to sum it up, what we could see over here is number one, a higher reward risk ratio, which is your monetary age, plays a major contribution to your expectancy per trade. So is to get your monetary age right first. That means to actually have a trading system or strategy that enable you to have a higher reward risk ratio trading setup. So once you get your monetary edge right, you fine tune your trading strategy or system to improve your accuracy edge, which is your win rate. All right. So with that, I've covered module 10 of Trade the Markets Like a Pro, and I see you all next in my next video.